I'm Marella Fernandez. Thanks for joining us today on Market Call. Teal Linde on the show, manager at Linde Equity Fund. He'll take your questions today on North American stocks. Here's how to reach us. 1-855-326-6266 if you want to call in. You can also send a question through email, marketcall@bnnbloomberg.ca. Teal, good to see you. Thanks for joining us today.
Thanks for having me.
So West Texas seems to be holding in the mid $90 a barrel right now, but I know there are tipping points that you have looked at that have different impacts depending on how high it goes. The first one is between $100 and $120. What does that look like?
Well, yeah, there's economic modeling has been done to see what the impact is on the economy based on certain price levels, and there's three zones. There's the headwind zone, there's a recessionary zone, and there's the systemic crisis zone. And so the first one is the headwind zone, which we mentioned is $100 to $120 a barrel. And that's where consumers will feel the impact, but it's largely offset by increased revenues, income, and tax royalties from all the oil production that Canada and the United States produces. And so, like, for example, the Alberta government, just on February 26th, they announced their budget outlook for the year, and they forecasted a $9 billion deficit. And 2 days later, the war started, and I've seen a report that suggests that if oil averaged $90 for the year, that $9 billion deficit is gone. The next zone is the recessionary zone, and that starts when oil is at $150. And at that point, there's going to be demand destruction. Consumers and businesses will drastically curtail their spending to help cover for energy expenses. And the reason why they pick $150 is because historically, whenever petroleum expenditures became 5% of GDP, you had a recession. And so at $150, that would be 5% of GDP, and so that's why they picked that number. And then the final one is the systemic crisis price point, and that's at $200 a barrel. That's what the Iranian regime has threatened that they want to see the price get to. And at that level, you basically have an immediate and systemic tax on every operational layer of commerce, which would likely lead to a synchronized global downturn. So as long as oil prices stay below $120, Canada and the U.S. economy should be able to persevere. Okay, so why is the breaking point higher now than it was decades ago? Well, because the economy, the U.S. and Canadian economy is much more service-oriented. So there's a lot less manufacturing, which is more energy intensive. And then another reason is that even the manufacturing does occur, there's more efficiency involved with the equipment and the machines. And I think the third factor is that Canada and the United States produce a lot more oil and gas today than they did, let's say, in the 1970s or in other prior periods when there was an energy oil and gas shortage. Got it. Okay, let's take a quick break. We will line up the first phone calls and emails for Teal Linde of Linde Equity Fund. Again, he's taking your questions today on North American stocks. Here's how to reach us. Back in a moment. Welcome back. We're going to start with an email from Fred. He has a question today for Teal Linde. He says, would love to get the guest's advice on GoEasy. Teal, I'm sure you followed GoEasy and seen its decline since it made some announcements last week that investors did not like. What is your take moving forward on GoEasy? Yeah, that was a massive hit. The stock fell off like almost 60% in a single day. So you had a double take. And so this company, for GoEasy, for those who aren't familiar, it's a non-prime or subprime lender to Canadians that have poor or limited credit histories, and it's a company that's had a very good long-term track record. But it looks like it got tripped up with the subprime lending to subprime auto buyers, and so like last week they announced that they basically cut their dividend, they pulled their three-year guidance. And it was a pre-announcement to their upcoming fourth quarter results, and they revealed a total net charge-off of over $300 million, which is a large amount for this company. Now, I think that to be fair to the company, I don't think it's a company-specific issue. I mean, there were two subprime auto lenders in the United States that went bankrupt last fall. And, you hear stories about the repossession firms or they got so much backlog they just can't keep up with all the volume. So, I mean, the emailer asked, what's the advice? This was last week was a pre-announcement. There's still a lot of uncertainty, and so I think I would wait until the results come out later this month and listen to the conference call and to gather more information before you decide what to do.
Okay, that is good advice. Let's move on to our first phone call from John in Montreal. Hi, John.
Hi, I want to ask your guest about Telus. I have it in my TFSA. I'm retired. I'm down about 30%. Is it worth it, in his opinion, to hang on, or do you think I should just, even though I can't use the tax loss, is it something I should redirect my money elsewhere? And I appreciate his advice.
Thank you for the question. John, people like that dividend, Teal. Is Telus worth holding on to?
I think it is. We actually own Telus. We're not happy with the performance of the share price. We do like the dividend. And our exit strategy on Telus is really to wait for a meaningful downturn in the market. Because one good thing about telecom stocks is that they generally hold up better than the market when there's a massive sell-off. And at that point, I think we're going to sort of basically cash in on our position and use it, deploy it into something that's more attractive. So for the time being, we're holding on to continue to collect the dividend.
Okay. That was for John. Let's go to Chris in Delta, BC. Hi, Chris.
Oh, good morning, Morella. Good morning, Teal. Teal, better get the bad ones out of the way here because I'm calling on Blue Owl, and I've stopped averaging down to it, but I'm curious what your thoughts are on the company moving forward. I'll hang up and listen. Thank you both.
Okay, thank you for that question. Another lender here, which is Blue Owl, also moving in the wrong direction for investors. What do you think?
Well, I mean, this is one where we can talk probably 5 to 10 minutes on with Blue Owl in the private credit sector. So to make it concise is that private credit's been around since the 1980s in its original form. And institutional investors have been investing in it all this time. And it really picked up steam after 2008 when banks were sort of curtailed their lending to companies. And in the last few years, private credit is being offered to retail investors. And with all this fear in the last few months about AI disrupting companies, particularly the software sector, it's prompted investors in these private credit funds, which are very illiquid, to want their money back. And because they're very liquid, they have these caps where they can only redeem up to a maximum of 5% of their assets per quarter. And so once they get beyond 5%, it's basically gated. Now the media reports this as that the redemption has been halted, investors can't get their money back, and other investors see what's going on, and then they say, well, I want to get my money out too. And you basically have like a run on the bank, and more companies or more private equity or private credit funds are being gated and hitting their limits. And so I think we've seen situations like this where an asset class gets into a lot of negative sentiment. And I say sentiment because the actual results of these private credit funds are still very pristine. I mean, you do have the occasional company that has gone into trouble, and that causes a sort of a fear. But in this kind of situation, you want to be invested in the industry leaders. And in the United States, those are KKR, Blackstone, Apollo, Ares, and Blue Owl. Now, Blue Owl is the newest, and it's less diversified, so I think that's why it's being hit the hardest. I would also add that there's a hedge fund manager in New York called Saba Capital Management, and the founder is a very vocal critic of the private credit space, but not necessarily the asset class, but really how it's being sold to retail investors. And he sees all the hysteria going on and a lot of anxious investors. And so he and another hedge fund have offered a tender offer to buy units off retail investors that are feeling so anxious. They do not want to wait any longer. They want to get out. They're prepared to sell at a loss. And they're offering a 20 to 35% discount to the net asset value on 3 private credit funds. And they're all Blue Owl funds. And so he was on CNBC last week, and it was raised that what he was doing. And he said that, he says, when we go bid for something, it's a sign that we think the manager is good. And so we share the similar sentiment, and so we're sticking with Blue Owl.
Okay, quick question. You mentioned that perhaps retail investors maybe aren't made aware enough about the redemption quality of some of this. Is that why he thinks retail investors shouldn't get involved or aren't marketed the right way?
Yeah, that's right. I mean, it's something. It's a feature of a non-public, non-trading private credit fund, and I think we don't know. I mean, we don't know when the advisors recommended these investments to their clients. Did they warn them that there's a 5% redemption cap? And I suspect they probably did, but at the time, no one was concerned about it. And now it is a concern. And some of the practices that this individual talks about is just he also cites examples where some firms are putting their interests, just greed, they're putting their own interests ahead of their clients' interests. And so, there is a question of whether or not private credit funds should be sold to retail investors because there's a bit of a mismatch. Private credit is something where you have a long duration, it's fairly illiquid, but retail investors are known to be a bit more flighty than, let's say, institutional investors, and that's, I think, is contributing to the problem.
All right, let's go to one last caller. Then Glenn is in Collingwood, Ontario. He's got a question. Glenn, go ahead.
Good afternoon. Teal, what's your current opinion on Five Below, and how would you compare it to the likes of Dollar General and Dollar Tree? Thanks for your comments.
Okay, that's a question. So it's a retailer. It's a discount retailer, Teal?
That's right. It's part of the dollar stores that are out there. And regarding the caller's question about how does it compare to Dollar Tree and Dollar General, Five Below is actually fully recovered from the sell-off. If you look at the 5-year chart, you'll see that it's back to where it was before. Dollar General and Dollar Tree are still struggling to get back up. And because it's come back up to where its previous highs, we've actually recently exited the stock to take advantage of stocks that have sold off in the software sector over the last couple of months.
Okay, that was for Glenn. Let's take a quick break. Teal Linde sticking around with Linde Equity Fund. Again, he's taking your questions on North American stocks. Back to your phone calls in a moment. Welcome back to Market Call. Let's go to Gus on the line. He's in Cambridge, Ontario. What's your question today for Teal, Gus?
My question is in the open text. Would you buy this stock at this price?
Okay, thank you for the question. Open text, like many of the tech firms and software in particular, getting hit. Teal, would you buy in where it is today? We'll take a look at the number in just a moment.
Well, OpenText this is traditionally an acquisition and growth through acquisition company, and more recently decided they want to focus on organic growth. And they haven't seen too much success at that. I think the revenue growth rate of this company is low single digits. And the question whether would I buy this stock, I think with the sell-off in software stocks that we've seen in January, February, you can find companies that are growing much faster at OpenText that are trading close to market average multiples. So I think I'd look elsewhere and take advantage of what other software stocks that have sold off that are more attractive.
Okay, is there one or two recommendations you can give, Gus?
I certainly can. That's the top picks at the end of the show.
All right, stay tuned for that. Let's go to an email then from Harper. What is Mr. Linde's opinion of AI's impact on application software, so like Adobe? Does he think AI will reduce the future growth of Adobe, or does he think the market has overjudged the impact of AI on Adobe and Adobe's growth will continue? Okay, we've had a lot of questions about the software space in general, Adobe more specifically. And they did report earnings, and investors have not been liking the stock for some time, ever since the AI idea of AI taking over what some of those programs can do. Do you like Adobe right now?
No, again, there are better software companies to invest in. And I think if you want to differentiate the group of software companies, you want to divide them into companies where there's one's offering a point solution and one where there's basically a platform. And if it's a point solution where one person or a small group of people are using the software for a current need, that's something that could be vibe coded away. That's something where AI can allow other competitors to create similar types of software. And that's something where the productivity is so good now with AI that these companies like Adobe that sell their software on a per seat basis. Well, if it used to, if 2 people can do the work now of what it used to take 5 people, then you're not going to need 5 subscriptions to Adobe. And so their growth rate's been decelerating because of these factors. But more so the sentiment's been negative on them, because they've had quarters over the last 2 years or over the last year where they've beat expectations and the guidance has been pretty good, but the stock gets sold off. So I think it's the sentiment's just been really negative on this company. And I'd have to say that in today's market, sentiment really seems to drive share prices more than fundamentals. So, but again, because it's more of a point solution rather than an enterprise platform, I would look elsewhere for an investment instead of Adobe.
All right, let's go to Fotini then. He's next on the line. He has a question. He's in BC. Hi, Fotini.
Hello, how are you? Hi, Linde. And by the way, we haven't changed very much. I remember you. You're my customer at Dino's restaurant in Port Moody. Anyways, so my question today is about Tesla. Short-term prognosis, what is it? Thank you.
Thank you for the question. Thoughts on Tesla? A lot of people have valuation concerns. Do you?
Yes, I do. But again, sentiment's what's driving this stock up. And so I think Elon Musk has moved beyond the automotive side of the business. I mean, the last new model that they had was a Cybertruck. That was like 5 years ago, and it wasn't a real success. And so he's encouraging investors to look beyond that, and he's really focusing on robotaxis and humanoids. And I just think that it's going to be more difficult there because when Tesla came out with their electric vehicle, they really had the first mover advantage. They were selling a product that they could brand, people were prepared to spend more money on, and they did very well. But robotaxis, there's 20 other robotaxi companies in the world. There's a lot of other companies making humanoid robots. I think it's going to be much more difficult for Tesla to replicate the success they had with their vehicles. But like I said, there's the sentiment's positive, and Elon Musk, I think he's probably the world's best stock promoter, and the valuation stays high.
All right, one to watch there. Let's move on to the next caller, Michael in Montreal. Hi, Michael. Michael, are you there? Okay, we may have lost Michael, but I think he had a question about restaurant brands, and we will pull up the owner of Tim Hortons and Burger King. They've been trying to revamp Burger King, of course, and dealing with a lot of input costs on the Tim Hortons side of things, especially coffee. What do you think about restaurant brands moving forward?
Yeah, no, these guys are doing well. I mean, they just Tim Hortons announced a 2.5% same-store sales. They've had positive same-store sales for 19 quarters. And then Burger King's also had positive same-store sales, although the franchisees aren't making as much money because beef costs have gone up 20%. And so their plan going forward really is to they want to grow their store count by 5% over the next couple of years per year. And they also want to get their franchisees, the percentage of restaurants that are franchised from 95% to 99%. And so, I mean, all these factors are bullish for the company, which is trading at a reasonable valuation. It's a company that I've considered looking at as an acquisition or for our fund. But if we were to do it, if you look at the performance for the last 2-3 years, it kind of oscillates. So you'd want to buy it on the lower end of its trading range.
Okay, let's get to an email then from Max. He says, wondering what Teal thinks of Manulife as a new buy. We've also had a few questions about Manulife and insurance space, generally speaking. Are you invested at all in any of the insurance lines?
We're invested in the property and casualty side of the insurance sector, but Manulife, I mean, it's attractive right now. It's pulled back. It's trading around 10 times this year's earnings. The banks are trading at much higher multiples, and Manulife's continue to have success in their Asia business and their wealth management. And if you had to press me on whether it's a buy, sell, or hold, I'd say it's a buy at today's level.
Okay, that was for Max. Let's take a quick break. We're going to have a look at past picks from Teal when we come back. Time now to have a look at past picks from Teal Linde from March 17, 2025, so a year ago. Teal, at the time, he chose Air Canada AC on the TSX at $15.49. And today it's up to $16.88, 9% upside here for return and total return. Do you remember what you liked about Air Canada a year ago?
Well, Air Canada is basically a year ago. It was not trading much higher than where it was in 2020 during the early stage of the pandemic. And yet the planes are much fuller now. Their balance sheet's a lot better. And so why should it be trading at the same price when their planes were 90% empty or they were issuing tons of debt? And so, I mean, it started to improve. And as of 3 weeks or 4 weeks ago, it was a better price today. But with the war and the high rising oil prices, the stock's obviously come off.
Have you held on to it?
Yeah, we still own it, and we still think there's upside because the company is trading at a discount to its historical valuation even before the war started, and even a sharper discount to its U.S. peers. So I think at $25 would be a much fairer price, and that's sort of what we have our sights on.
All right, let's move to your next past pick then. Pinterest, PINS on the NASDAQ. At the time you looked at it, it was 3207 US. It's down to 1864 now, 42% drop for return and total return. How is Pinterest doing? What is its challenge here? Why has the stock dropped the way it has?
Well, there's two reasons why it sold off recently sharply, because the software stocks have sold off in general. And then when they announced the results, their revenues weren't as good as what the market was expecting. They cater to large companies as their source of advertising revenue, and those companies have pulled back slightly. And that's because they want to save money because of the tariff expenses, and so they want to protect their profit margins. So Pinterest now wants to go after, well, they want to get that business back, but they want to go after medium-sized and small-sized businesses. Now, how they're doing from a customer and product basis, they're actually doing very well. If you look at the major social media companies out there, Pinterest is growing its user base as the second fastest growth rate of all the players, and they're only behind TikTok. And so last quarter they grew their user base by 12%. And so the engagement is healthy as well. And so I think that in the long run, you want to have a company have a good product and quality service, and that's what you have with Pinterest. What's really interesting with them is that they have, I don't know if you're familiar with Elliott Management. Elliott Management
Yes.
is the preeminent, oh, yeah, that's great. And so because Elliott Management, as you know, is the preeminent activist hedge fund in the world. And if you're wondering why Suncor has done really well in the last 2 to 3 years, because they got actively involved in 2022. And so Suncor is their third largest position. Pinterest is their fifth largest stock position. They've been a shareholder since 2022. And they've just lent Pinterest recently $1 billion at a 1.7% interest rate loan to use to go and buy back stock. And they can convert, and they have to deal is they can convert the stock or that loan to equity at $22.72. And so they're an owner, they're on the board, and I think that the fact that they're prepared to invest $1 billion at current prices is a bullish sign for the stock.
All right, good to know. Let's move to your last past pick from March of last year. Alphabet, Google, GOOGL on the NASDAQ. At the time, it was 164.29. It has more than doubled here to 305.85. Today, to a return here of 86%, and almost doubled, and 87% total return here. This is something I imagine is maybe core for you that you've held on to and will for a while?
Yes, correct. We've probably held it since 2015, and they're really emerging as an AI juggernaut. I mean, Google was the inventor of it's called the transformer architecture, which is the foundation of what all generative AI is built upon today. And they also have their custom infrastructure with their tensor processing units, where they're just building their own chips to cater to exactly what they need, and weaning themselves off NVIDIA, which has to sort of make chips for all kinds of different customers for different purposes. So they have that advantage as well. And then they have distribution. I mean, there's over 750 monthly users of Gemini, and they're integrating that with Google Search, Android, and Workspace. And so it's a very vertically integrated AI giant, and some people think it's going to become the most valuable company in the world eventually.
All right, let's leave the block there because we're out of time. We're going to take some more phone calls when we come back. Teal Linde of Linde Equity Fund answering your questions about North American stocks. Back in just a moment. Stay tuned. Welcome back to Market Call. We will go to an email from Brian. He says, question for Teal Linde, is Constellation Software a buy at today's prices? I think people are now getting over some of the software concerns, Teal, and thinking of buying up some of these stocks that dramatically dropped on those concerns. Would you buy Constellation Software?
Well, Constellation Software there are other stocks that we prefer to buy instead. And largely because Constellation Software's business model has really changed from its glory days. I mean, you have to remember, this is a company that had most of its success over its history buying tiny companies, $5 to $7 million companies, because private equity really wasn't interested, so they can get a really good price on that, and as a result have a high return on their invested capital. And they did that for many years, but as they got bigger and bigger, they had to start the $5 to $7 million companies weren't going to move the needle, so they started buying larger companies, and then they had to compete with other bidders, and they take longer to play out. And even more recently now, they're taking stakes in public companies. So it's a really changed business. And so I sense that there's people out there that expect the good times to continue, and I think that's going to be very difficult. And so they've had a tremendous run. It's one of the most successful stocks in the TSX over the last 25 years. But I think it's time to I'd be looking somewhere else.
So you're concerned not so much around AI and software, but the fact that they don't have anything big enough to buy these days. There's nowhere else for them to go.
Yeah, well, there's companies out there to buy, but the problem is that they're buying companies that other companies are also interested in, and their selection is more limited, and it's just you're not going to be able to get the same kind of returns as they used to do in the past. So I just think they're going to have a more difficult time sort of replicating the growth rates that they've had previously, and yet a lot of people I think expect or are hoping that will continue. I think it's going to be hard.
All right, let's move on then to our next caller. Bob is on the line. He is in Bowmanville, Ontario. Hi, Bob.
Good afternoon. Teal, Visa, it's come off here a little bit here, even over the last year. It tends to be the preference over Mastercard for most people, I think. Just your thoughts on it, and more importantly, would this be a good entry point?
Okay. Thank you for the question. Both Visa and Mastercard have been going sideways, now down. Do you hold Visa? Do you like the space?
Yeah, we've been long-term holders of Mastercard. And I know Visa is probably more popular, but Mastercard, if you take a look at their growth rates over the last 5 to 10 years, you'll notice that Mastercard's actually grown slightly faster. And it continues to grow slightly faster than Visa. It's interesting that a year ago, the analysts were expecting Mastercard to grow. If we go back a year and a half ago, they expected Mastercard to grow 12% top line growth in 2025, and Visa to grow 10%. And it turns out that Mastercard grew last year 16%, and Visa grew 12%. So they both did better than expected. Mastercard did a lot better. And so again, for this year, the growth expectations have moderated down. Although Visa's growth expectation is, I think, 11.6% for this year, and Mastercard, I think, is 13%. I mean, they're basically dominant companies. They're benefiting primarily because the cross-border fees that they get. People are traveling more. And you can see that in some of the travel stocks, Booking.com, Royal Caribbean. And when people travel and they cross borders, Visa and MasterCard make a lot of money from that. And so I think that's part of the tailwind that they're enjoying.
So you're obviously hanging on. Would you tell people just to hang on to the stock then?
Yeah, again, Visa and MasterCard, they also got impacted by this whole AI scare. They thought that because people are going to use AI agents, and these agents are going to decide where to buy, to do the transactions, are going to have the smaller fees, and then Visa and MasterCard might get impacted by that. I think it's a little bit extreme, but nonetheless, they're down as well, and I'd hang on at these levels.
All right, let's go to an email from Kevin then. Could I get your guys' opinion about Bank of America? Is it at a buy at today's price? Let's have a look at Bank of America, wondering about financials in the U.S. I know they're going to benefit from deregulation. What else could be a tailwind for them, and would you pick it up here?
Well, I guess they got two tailwinds. One's their valuation. It's trading around just above 11 times earnings, which puts it at a much more attractive valuation than the Canadian banks, which are averaging slightly over 13. It's also trading at a discount to JP Morgan. I think the biggest tailwind for Bank of America is that it's working towards emulating the success of JP Morgan. JP Morgan has built a collection of dominant interconnected brands, and Bank of America, they've got dominant brands, but they're not interconnected and synchronized together. And I think the CEO of Bank of America realizes that. And so they're working towards that. And I think there's an opportunity to create a lot of shareholder value by simply following JP Morgan's playbook over the next few years.
All right, good to know. Let's go to Jim, who is in Peace River, with a question. Hi, Jim.
Doing?
Jim, are you there?
You bet.
Go ahead.
So I'm wondering about Canadian Natural. They're my number one holding, and I love the dividend. I've had them for about 5 years now. But it seems to me they're at an all-time high. Can you see the share price growing much more than it is now? aside from all that stuff in the Middle East. Take that up.
It's really hard to not look at the stuff in the Middle East, Jim, but Teal, if you do try and extract that from the picture, what would you do here? What do you think is down the line for C&Q?
Well, I mean, thanks for the call. I mean, the call is correct about the dividend. They've just raised their dividend just recently for the 26th consecutive year in a row. And its stock has moved up very nicely. But what's interesting about C&Q and the energy sector in general is that if you look at, let's say, look at the XEG, the iShares ETF that captures the energy sector. If you look at it, you'll notice that it really went up on a tear starting in the beginning of January. And yet I've seen analyst reports trying to explain like why are certain stocks up, and they can't explain it. And yet we've had this big run up in the energy stocks and from January and February. Now, a lot of people believe that the market is forward looking, and it really makes you wonder if they was anticipating what was going on in the Middle East. But since war has broken out in the Middle East, the gains in the energy stocks, there have been some, but most of the gains this year, the vast majority have happened before the war started from January to February. And so I think that energy stocks have had a big run already, and I think depending on how much you have, you might want to take some profit because in certain cases, not much has changed, although oil prices has risen, so perhaps that supports the current level.
All right, that was for Jim. Let's get to Ghulam before we take a break. He's in Toronto. Ghulam, what's your question today?
Hi, my question is on energy in general. I hold some oil producers, Suncor, Birchcliff, Cenovus, and Vermilion. And I'm thinking that with the oil price at close to $100 now, if there is some sort of a peace agreement, oil prices will drop significantly. Should I be selling the producers right now and take a profit? And if so, or should I hold? And if so, which one would you sell right now?
All right. Thank you for the question. Two-part question here. Should Ghulam sell, and is there a recommendation of which one?
Well, like with my previous discussion with the previous caller, that the energy sector has had this large run through January and February. And if oil prices were to fall off, I mean, that run occurred even when oil prices were at $70 oil. I just think when you consider how much it's run up, war aside, in the first 2 months of this year, I think there's grounds to probably take some profit, and particularly if you have a number of these companies. And in terms of which ones to sell, I think you might want to consider what weightings you have, and whatever's become the biggest weighting, you probably decide that way.
All right, let's take a quick break then. We'll get back to more of your phone calls with Teal Linde of Linde Equity Fund in just a moment. Stay tuned. Welcome back. Let's go to an email from George. She says, I'd really like to know your guest thoughts on Bombardier. I've held it for some time, and I'm wondering if I should trim or add. Bombardier has done well. Teal, would you trim at this point?
Yeah, the choice between trimming or adding, I would trim. And Bombardier is an example of a very successful turnaround. I mean, if you go back to 2020, when the pandemic hit, Bombardier, I think it was around $10. And so it's almost been a 25-bagger in 6 years. And so if the person, I think the emailer said he's had it for some time, so he's probably up at least double, 2, 3, 5, 10 times his money. And so what's happened is that they simply back in 2020 they had sort of downsized to just focus on business jets. They had a lot of debt. They've really sort of improved the balance sheet, and business jet orders have really been strong the last number of years. They're now getting into defense business with the federal government, and the valuation is much fuller now. And so I think I'd trim.
All right, good advice for him. Let's go to Ben, who has written in. He says, what does the guest think about TD Bank? TD was lagging for a little while on the penalty out of the U.S. It's come back quite a bit. Would you put new money into TD, or would you hold what you have?
I just hold. TD Bank is a bank that we do own, so we follow it quite closely. And Canadian bank stocks have had a huge run. I mean, almost doubled for a couple of them over the last 2.5 years. And with respect to TD Bank, they were in the penalty box with the AML troubles and the big fine. But they did have a large stake in Charles Schwab, which they got from selling TD Ameritrade. So they sold that, and they could use that to help buy back stock. And in the U.S., they have a problem where the Federal Reserve has put a cap on how much assets they can grow with their with their retail bank. But they've been successful in optimizing their assets there, and so that's worked out well. The only weakness, I think, with TD Bank is that they're in Canada with their personal and commercial banking. They're lagging their peers. Now, rather than a weakness, you could probably look at that as an opportunity where if they can improve that could probably add some incremental upside to TD Bank. But generally, the banks as a group have run up so much that they're either a hold, or if your weighting has gotten to a large overweighted position, you might trim and take some profit.
Do you feel that the cap on their U.S. assets will hinder them down the line?
It is a hindrance because Wells Fargo they were capped at $2 trillion since 2018, and you can no longer grow your loan book, and your assets are capped. And so, I mean, the optimization is you can do that for a while, but eventually when you're fully optimized and you still can't grow your asset base, then that will be an issue. Now, unfortunately, the difference between TD Bank and Wells Fargo was like 100% capped. It's for TD Bank, it's just their U.S. retail banks, not their capital market side, and so it represents about 25% of the assets of the bank, which you think is not too bad, but it generates actually a bit more than that in terms of earnings for the bank. So they still have other areas where they can grow the business, but ideally they want to get that cap taken off so they can continue to grow their asset base in their retail operations.
Okay, let's go on to our next email then from Drake. He says, thoughts on Novo Nordisk, of course, Pharmacare in the space with the weight loss. And I don't know if you're invested in Pharmacare. What are you doing right now in this sector?
We're not invested in Pharmacare right now. We'd like to, but it's very complicated. The government gets involved, and I mean, for like Novo, for example, the weight loss drugs, you're seeing their prices come down. You've got, I think, the ingredient for the weight loss drugs, the key ingredient, is actually coming off patent this year. And so you're going to start to see generics come on the market by the end of the year. You've got the oral pill form of their weight loss drug is coming on the market. That's going to be cheaper than the injected version. And then you have governments that are negotiating caps on how much they're prepared to reimburse. And so there's downward pressure, not just on Novo drugs, but just pharmaceutical drugs in general. And when you consider how indebted the governments are, how large their deficits are, one of the areas that they can find to save money is just to lower the reimbursements of what they're covering in the United States for Medicare and Medicaid. So there's a lot of downward pressure, I think, in the healthcare sector. Although there has been some regulatory changes that have sort of boosted certain pharmaceutical companies, but overall we're not in that space. And one of the problems with pharmaceutical companies is that they have these patent cliffs. And it's like every other company. If you have other companies don't have the situation where after a certain amount of time, competitors can suddenly start making generic versions of their product. You don't really see that with software companies. You don't really see that with a lot of other different companies in different industries. So the patent cliff is always going to worry us. We tried investing in these companies before, and eventually we get tripped because eventually time goes by, the price starts going down because people start worrying about the patent cliff that's 5 years away.
Yeah, so a limited time to make that money. Let's take a quick break. We're going to have new top picks from Teal when we come back. Stay tuned. Join us tomorrow for Market Call. Christine Poole will be with us on the show. She's co-chief investment officer at Davis Ray. She'll take your questions on North American large caps. That's tomorrow. And if you missed our show, you can check out the daily podcast, find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time for new top picks from Teal Linde. They're going to start with Microsoft, MSFT on the NASDAQ, which suffered a similar fate over software concerns and has been pushed down. What do you like about Microsoft down the road?
Well, Microsoft is chosen. I mean, I'm actually going to recommend two software companies, and Microsoft is the safer pick. And so the value, and like I said before, they get a massive sell-off in software stocks. where you've seen these rapidly growing double-digit growers that used to trade at that have always traded at premiums suddenly come down where the premiums are basically virtually gone. And so Microsoft it's a resilient company. It's got a lot of growth potential. It's got a AAA balance sheet. And yet you can buy it today at 21 times this calendar year's expected earnings, which is the same PE ratio of the S&P 500. So it's being valued as if it's an average valuation of the market. And yet I think people would agree that it's far greater than average company. And so it's growing revenues and earnings in the mid-teens, 21 times multiple. It makes it an attractive stock to buy today.
That is Microsoft. Let's go to HubSpot, HUBS on the New York Stock Exchange. This is another tech company that there have been concerns about. They do integrated marketing sales service. They put everything together, and it's really come down over the last year. It's at 265.42 today. Tell me what you like about it.
Well, HubSpot is very similar. It's basically it's similar to Salesforce. I think more people are familiar with Salesforce, which is a customer relationship management platform software. Salesforce caters to large companies, and they actually vacated the medium-sized and small-sized businesses, which opened up the opportunity for HubSpot. And so HubSpot is very similar to Salesforce. It basically helps companies manage everything for their marketing, their sales, their customer service, and then it basically operates as like a system of record where all this information is integrated and gathered and governed and secured. And so it's a type of software that is very unlikely to be vibe coded away. And it's also growing revenues this year. 18% is the anticipated growth rate. Earnings are expected to grow faster. And it's trading at 21 times this year's expected earnings, just like Microsoft and just like the S&P 500. And so, like I said, it's very rare to find companies growing this fast, trading at market average multiples. And so that's our second top pick.
What are you looking for when you're reconsidering software stocks at this point?
Sorry, what was the question?
Because software has been so pushed down and there are concerns about AI, what are you looking at for software stocks when you're reconsidering them now?
Well, it's really you want to looking for a moat. I mean, the big fear is that vibe coding is going to allow companies and people to create their own software, and basically cannibalize the existing providers of software out there. And I think we've talked about how the point solution software is one that's probably more at risk, and the ones that are more enterprise platform based is probably going to be more resilient. But again, I'd also like to question this whole idea that companies and people are going to start creating their own software because they can do it and save money. Well, I mean, open source software has been around for years, and yet companies prefer to buy the commercial version and pay the higher price. The idea that you're going to have a million different companies creating their own version of their software rather than having one or two or three organizations concentrating all that talent to create the best software, to keep it up to date, to innovate, keep it secure. I just think the whole opportunity of cloud was that companies can get their software off premise and not have to worry about it and have someone else do it. So the idea that it's going to go back into the hands of the people in their companies, I don't think that's going to happen. I mean, it may happen in cases where an individual has a point solution or there's a little tool that they want to create, but to replace system-wide systems of record platforms, I don't see it happening, which is why when the software sell-off occurred, it was indiscriminate. Everything sold off, and so you can sort of pick the ones that you thought are going to be able to persevere forward, and that's sort of how we approached it.
All right, let's get to your last pick here, which is Colliers, CIGI on the TSX. They do real estate services. Same theory around this business?
Yes, I mean, this is also impacted by the AI scare, not necessarily as a software company, but there's this fear that agentic AI is going to replace human agents. And I would suggest that in the commercial real estate sector, it's complex. There's a lot of nuances. It's very localized. And it's a business that's really driven by relationships. And the trust factor is really important. And I think that AI can help with some of the financial modeling and the data processing. But when you're considering the size of these deals, people want to deal with a human at this point. And maybe 20 years from now, it's going to be different. But for the foreseeable future, I think it's going to continue to be a relationship, human to human business.
All right.
Colliers is investing a lot in AI to help to improve their business operations, which I think is going to give them an advantage over smaller companies where they can consolidate, buy out.
Gotta go, Teal. Thanks so much for joining us, and thank you for watching us today on Market Call. We'll see you back here tomorrow.